Hello, and welcome to Investment Insight, your clear take on the markets. Let's get started. Today, we're doing a deep dive into, well, the absolute core of the Eurozone. And we're not talking about the usual risk players.
No.
We are focusing squarely on Germany and France. I mean, these are the two countries that have been the economic bedrock, the dual anchors for the entire European project for decades.
That's exactly right. And, it's so easy for an investor to just see a headline, something about slowing European growth, and just dismiss it.
Oh, it's just a cycle.
Exactly. Just a bit of turbulence, maybe some post-pandemic noise. But, well, the material we've been analyzing suggests something much, much deeper.
Something more corrosive.
Yes, corrosive is the right word. We're talking about deep structural fault lines, the kind that are forcing serious investors to really rethink their entire European strategy as we look into 2026.
So our mission today is to really get into the why. Why are the structures of these two dominant economies showing such severe strain right now? To frame this, maybe we can use a clear analogy. Let's think of the Eurozone as a powerful, but, well, an increasingly aging two-engine airplane.
And those engines are Germany and France, of course. They've always provided that main thrust, that stability for the whole system.
Right.
But now, imagine both engines start to sputter. And not because of some temporary bad weather, but because their internal mechanics, their critical components are actually failing.
So this needs more than a quick fix.
Oh, much more. This requires an expensive, slow, and frankly, often politically painful overhaul. And that's the risk premium we're all trying to calculate right now.
And we have to start with Germany, the famous industrial engine that has, well, unfortunately re-earned that old title of the sick man of Europe.
It's a tough label, but some of the analysis is pretty stark.
Yeah, recent reports suggest 2025 could be the third straight year of stagnation or even outright recession. So we're way beyond just a simple cyclical slump here. This points to something structural.
It really does.
Yeah.
And the signs of that structural damage, they're most obvious when you look at the legendary German auto industry. Historically, the very heart of their manufacturing power.
So what's the data telling us there?
Well, the data confirms some significant widespread distress. Reports indicated that by the end of September 2025, the sector had cut roughly 48,000 jobs year over year.
48,000 in a single year in a single sector. That's a staggering number. But does that figure really capture the whole problem? The official numbers, they usually just focus on the big guys, right?
That's a great point. The pain usually hits the smaller, often non-public component suppliers and regional partners much harder and faster.
Of course.
It absolutely does. I mean, when the major manufacturers sneeze, the hundreds of component suppliers, the specialized tool makers, they all catch pneumonia. It creates this huge shrinking ripple effect.
And that makes any regional recovery that much harder.
Exactly.
And a key driver of this crisis is something analysts are calling the China boomerang.
Yes, this is just a classic case of yesterday's strength becoming today's liability. I mean, for decades, German manufacturing thrived by using China as its biggest customer.
Selling them high-end machinery, luxury cars.
Exactly. But now, China has very rapidly transitioned from being the best customer to being the primary global competitor.
Yeah.
Especially in strategic areas.
You mean electric vehicles and, maybe more importantly, the industrial machinery itself?
Precisely. China is now making its own advanced machinery that rivals, and in some cases even surpasses, some of the legacy German models. At least in terms of cost and digital integration, they're taking market share.
So the investment Germany made in China is now?
It's now fueling its fiercest competition. That's the boomerang.
And as if that wasn't enough, Germany's reliance on the U.S., its other huge partner, is also becoming a vulnerability.
Correct. I mean, Germany was still very reliant on U.S. trade in 2024, but given the current climate of increasing U.S. protectionist risks, the constant threat of new tariffs.
The export engine is getting squeezed from both sides.
From the East and the West, simultaneously. It's a geopolitical squeeze that's very difficult to solve with just monetary policy.
And on top of all that, there's the internal high-cost structure, which is proving incredibly hard to reverse.
Right.
The initial energy shock from the Russia-Ukraine conflict has eased a bit, but labor costs, regulatory overhead, energy costs, they all seem stubbornly stuck at these new, higher levels.
And we have to talk about the slow pace of digital transformation. I mean, Germany is synonymous with engineering perfection.
Always has been.
But the overall adoption of digital tech, of AI, across its legacy industries, It's been noticeably sluggish compared to rivals in the US and Asia.
Yeah.
That inertia is creating a real structural weakness.
Hold on, Germany has always adapted in the past. Think about reunification. Why is this digital shift so different, so much harder for them?
It's the speed. The sheer speed of this shift is unprecedented. In past industrial revolutions, Germany had deep capital reserves and a huge captive export market.
And now?
Now, the capital is strained, and the market China is actively building that future itself. Digital transformation isn't just about software. It's about changing culture, and that takes time they might not have.
So to bring these big macro costs down to a tangible level for you, the listener, we need to talk about some on-the-ground metrics. One source highlighted the troubling rise of infrastructure crime.
This is where you really see the friction in the real world. We're seeing a noticeable surge in crime, specifically organized groups cutting and stealing expensive copper cables from EV charging stations.
And why should a global investor care about a few stolen wires?
Because it's a perfect example of what you could call a field-level cost shock. It bundles together several really costly trends. First, high raw material prices. Copper is valuable.
Right.
Second, the urgent, expensive need to expand this green infrastructure. And third, it jacks up the operational, the maintenance, and insurance costs for every single charger network. It's an immediate, unexpected expense in their green transition.
And that cost theme goes straight into the cost of living, which eats into consumer spending. I mean, look at the housing shock. Data shows rent in Berlin has surged by 32% since 2021. Some reports say over 40% in 5 years.
That kind of growth is just unsustainable. Rent hikes like that severely constrain consumer spending on everything else. It's a huge drag on domestic demand. And crucially, it makes it so much harder for cities like Berlin to attract the young talent and startups they desperately need.
So if we synthesize all of that for Germany, it seems like our analysis points to this deep split, a phenomenon we could almost call
The two Germanys.
Exactly, the two Germanies.
And that's really the crucial investment takeaway here. While we expect the overall recovery to be slow, maybe not really rebounding until late 2026, the pain is not uniform at all.
Okay.
The old core automotive, paper, textiles is deeply pessimistic. But we see other sectors like defense, shipbuilding, aerospace showing clear signs of resilience.
And why those sectors specifically? I mean, are they really big enough to offset the headwinds in manufacturing?
That is the challenge. They're smaller, but their resilience comes from one key place: increased public investment and shifting geopolitical priorities. The rearmament push, for example. So investors have to shift their focus from the private export sector to these government-backed areas.
Okay, let's unpack this and shift gears to the other aging engine, France. If Germany is dealing with industrial costs, France seems to be grappling with, well, the cost of national agreement. The worry here is less about output and more about solvency. Analysts are starting to worry that France could be becoming the second Italy.
And the core issue in France is debt. And more than that, it's the political inability to get a handle on it. As of the first quarter of 2025, France's national debt hit 114.1% of GDP.
Wow. And just for context.
That's way above the Eurozone average, which is around 88%. It puts France up there with the highest in the EU, just behind Greece and Italy.
And the IMF has been pretty clear on this.
Oh, absolutely explicit. They've stressed that France needs immediate and, frankly, painful fiscal consolidation, no matter how politically difficult that is.
And that political difficulty is immense. Which brings us to a really fascinating social phenomenon from late 2025, this viral movement called Nicolas qui paye.
Nicholas who pays.
Right. Tell us more about what that reflects.
Well, this movement just powerfully captures a deep generational and economic conflict. It's driven mainly by middle-class and younger workers, millennials, who feel they are disproportionately burdened by a heavy tax load.
They're the symbolic Nicholas who pays for everything.
Precisely. To support the current, very extensive and expensive pension and welfare system.
So this viral movement is really just a symptom of these core tensions: high taxes, soaring housing costs, stagnant real wages, and that contentious policy of automatically indexing pensions to inflation.
Exactly. That automatic indexing means pension costs just shoot up, even when the economy is barely growing, putting the whole burden on current workers. So for an investor, this isn't a moral issue. It's pure policy implementation risk.
The more social resistance, the harder it is to reform.
Exactly. The higher the political cost and the slower and weaker any necessary austerity will be. If you can't get social consensus, you can't credibly balance the books.
And we saw the market react to this instability. Throughout 2025, all the political fights over budget cuts put real pressure on the national bond spread.
Yes, the gap between the French 10-year bond, the OAT, and the stable German bond.
Why is that spread so critical for our listeners to watch?
Because it's the market's real-time, real-money gauge of risk. When that spread widens, it means investors are demanding a higher premium to hold French debt over German debt. It signals higher perceived risk.
And that directly raises France's borrowing costs.
Right, which hinders any potential recovery. It's a vicious cycle. And of course, this kind of uncertainty always drives investors toward safety assets.
Gold, for example.
That's a classic confidence metric. While specific stats on personal gold buying can be tricky, multiple sources confirm a broader trend in Europe. Investors were clearly upping their allocation to safety assets. We saw big flows into gold ETFs and more demand for physical bars and coins in 2025. It's a tangible sign of shaken confidence.
So if we synthesize the French variable for 2026, the key metric for investors isn't really GDP growth.
No, not at all. The key variable is whether the government can articulate a clear, credible fiscal path that actually restores market confidence. And, critically, how much that social resistance like Nicolas Quipé limits the speed and force of any austerity. The market wants action, not promises.
So let's pull all this together for the global investor, because the data suggests the biggest risk to Europe isn't a total collapse, but differentiation.
Absolutely. Europe is broadly heading for slow growth, low inflation, but the main risk is that widening gap, the sheer differentiation in the risk premiums between countries. Treating Europe as one single block has never been riskier.
So the key word for European assets in 2026 isn't recession, it's repricing.
Precisely. We have to look at Europe as a conditional opportunity, not just a market that looks cheap on historical metrics. That conditionality comes from the fact that these structural issues are incredibly expensive to fix.
Which brings us to this idea of the cost of governance.
This is the discount you have to apply. The cost of governance, the painful transition costs in Germany, the social agreement costs in France, they are high. And they justify a sustained valuation discount until they're resolved. You can't just buy the index anymore.
This means investors have to completely change their framework, especially for Germany. We have to stop thinking of Germany as just manufacturing.
That old core is struggling. Investors need to be hyper-selective. They need to focus aggressively on sectors benefiting from that public investment we mentioned. Defense, aerospace, specialized infrastructure, shipbuilding. That's where the resilience is.
And for France, it's about understanding the risk hierarchy.
Yes. Since French bond spreads are so sensitive to political news, the first line of transmission for French risk isn't the stock market. It's sovereign debt. Then it'll hit the banking sector, and finally real estate finance. Watching that OAT bond spread is your early warning system.
And just to circle back one last time, we need to remember those ground-level issues like the Berlin rent surge or the EV charger theft. They're more than just anecdotes.
They are powerful, real-time signals. These life cost metrics, they move policy faster than slow, lagging macro data. When the public feels the daily cost of living, it forces politicians to act. And that inevitably impacts the cost structure for every single European business.
So the data clearly suggests Europe isn't facing a collapse, but a fundamental repricing of risk and opportunity. And it's based heavily on national governance and the speed of adaptation. You just can't invest in Europe as a single block anymore.
And the rise of movements like Nicolas Quipé and these physical friction points like copper theft, they underscore a key global investment question you have to consider. How do you accurately price in the cost of social consensus when a country needs deep, painful reform? That consensus is becoming the most expensive asset in Europe.
That's a truly provocative thought to leave you with. Don't forget to subscribe and hit that like button.